Welcome to the Deep Dive. We are so glad you're joining us today because we've got a fascinating one for you. We are looking at the invisible mechanics of the global supply chain, which, sounds like a lot.
It really is the lifeblood of the physical economy, though. I mean, it impacts literally everything you buy.
Exactly. And to unpack it, we are using a very specific primary source today. The Q1 2026 earnings conference call of Knight-Swift Transportation Holdings.
Ticker symbol KNX for those following along.
Right, KNX. The call was held on April 22nd, 2026. And we also have their corporate profile to help us out.
Which is helpful because Knight-Swift is, they're a dominant force. They operate all over the U.S. and Mexico.
Yeah, across four main segments, right? You've got truckload, LTL, which is less than truckload, logistics, and intermodal. They serve everybody from retail to automotive.
They are massive. So when something happens to Knight-Swift, it is a bellwether for the entire industry.
So here is the hook, and this is what really caught my eye. Right at the top of the source material, there is this fascinating contradiction.
Oh, the earnings per share drop.
Yes. On paper, the company had a brutal first quarter. I mean, adjusted earnings per share plummeted from 28 cents all the way down to 9 cents year over year.
Which is a massive drop. 2/3 of their earnings just gone.
Right. It's huge. Yet, the CEO, Adam Miller, he gets on the call and says there are, quote, more reasons to be optimistic about our industry than we have seen in over 4 years.
It's almost counterintuitive.
It's totally counterintuitive. So, okay, let's unpack this. How can the math look so bad, but the leadership is signaling a 4-year high in optimism?
Well, to understand that, we really have to look past the top line financial noise. Things like bad weather and administrative hiccups. We need to examine the actual structural changes happening in the freight market right now.
Because what happens to Knight-Swift trucks eventually hits your wallet, right?
Yeah.
It impacts the price and availability of everything you pick up at the grocery store.
Absolutely. So let's start with those Q1 2026 financial realities.
Yeah, let's break down that drop. So consolidated revenue, if you exclude fuel surcharges, it was essentially flat.
Right.
But the adjusted operating income took a $37 million hit compared to last year.
And $37 million sounds terrifying, but you have to look at what actually drove that drop. It wasn't necessarily core operational decay.
No, it was very specific anomalous events. Like the CFO broke it down on the call. $18 million of that drop was an adverse arbitration ruling on a 2022 LTL claim.
Which is just a ghost from 4 years ago finally showing up on the balance sheet.
Exactly. It's an $18 million hit from 2022. It doesn't tell us anything about how trucks are running today.
Right. And freight arbitration moves incredibly slowly. It's a long-tail liability.
And then there was a $4 million adverse tax decision down in Mexico.
Again, an administrative clawback. It's frustrating, but it's not a structural flaw in the daily operations.
So that's $22 million right there out of the $37 million, which leaves us with this $12 to $14 million negative hit. And this one is physical. This was from severe January winter storms and rising fuel prices.
Yeah, the winter freeze. And this is actually where Miller's optimism starts to make sense.
Wait, really? Because winter happens every year.
It does. But if we connect this to the bigger picture, the weather event in January acted as a massive stress test for the entire North American supply chain.
Okay, how so? I mean, don't they have routing algorithms and weather models for this exact thing?
They do,
yeah.
But a healthy market can usually absorb a winter storm. If you have excess capacity, surplus of trucks sitting around, a lane freezes up, shippers just pivot. They tap the secondary market and freight keeps moving a few days later with minimal rate freight.
Oh, I see.
But the transcripts note that this January, the storm caused, quote, acute tightness and an elevated spot market almost overnight.
Almost overnight. So the slack was it was gone.
Exactly. The fact that a regional storm caused such sudden national disruption proves the market is operating on a razor's edge.
I like to think of it like a game of musical chairs.
Oh, that's a good way to look at it.
Yeah, like imagine you're playing and someone has been quietly pulling chairs out of the room for months. You don't really notice the shortage while the music is playing, right?
Right. Everyone is just walking around, moving freight.
But then the music suddenly stops. That's the winter storm. And suddenly everyone scrambles for a seat and realizes, wow, half the chairs are gone.
That's a perfect analogy. The spot market is the ultimate real-time indicator of supply and demand. If there were still a glut of trucks, spot rates wouldn't have spiked like they did when the snow hit.
So it's brittle. The system is incredibly brittle right now.
Highly brittle, which means when shipping capacity gets tight, transportation costs rise.
And that's why this matters to you, the listener, because when it costs a shipper more to secure a truck, they pass that cost on to the consumer. Groceries, electronics, building materials, it all gets more expensive.
Exactly. So the obvious question is, where did all the capacity go? Why are there fewer chairs?
Right. And according to the call, they aren't disappearing by accident. This capacity is being intentionally regulated out of existence. It's a purge.
A massive purge. CEO Adam Miller noted that over the past 3 years, the one-way truckload market absorbed this huge influx of capacity.
Because of the 2021 pandemic boom, right?
Right. When supply chains choked and spot rates went through the roof, everyone wanted a piece of the pie. The barrier to entry was practically zero.
People were just buying used cabs and hitting the load boards.
Yeah. But Miller pointed out that much of this new capacity wasn't, quote, playing by the rules. They were self-certifying logs, skimping on maintenance and essentially exploiting the system.
And exploiting immigrant labor for below livable wages, from what the call hinted at.
Yes. But now there is an ongoing aggressive crackdown. The FMCSA, the Federal Motor Carrier Safety Administration, and the Department of Transportation are going after them.
Yeah, the source mentions they are targeting non-compliant CDL schools, invalidly issued commercial driver's licenses, and what they call chameleon carriers.
Chameleon carriers are fascinating.
Oh, tell me about it. It sounds like a shell game.
It is a shell game. So say a bad actor operates an unsafe fleet. They get a terrible safety score, maybe a DOT shutdown order, or their insurance premiums become mathematically impossible to pay.
So they just shut down the LLC.
Exactly. They abandon that motor carrier number, open a new corporate entity, and reopen the next day under a new name.
Just completely dodging their own safety record.
Right. Same trucks, same bad practices, but a fresh, clean DOT number. But the current administration is pushing hard to clean this up. They are cross-referencing VINs and addresses to freeze these reincarnated authorities.
And we should note, just impartially reporting on the context from the call, there are several legal and regulatory proposals pushing this along. They mention Lay's Law, the Montgomery case, English language proficiency requirements, and a huge proposal for a minimum $5 million liability insurance mandate.
That $5 million insurance proposal is a market killer for the undercapitalized guys. Right now, a standard policy is around $750,000.
Oh, wow. So jumping to $5 million.
Yeah. If you are a marginal operator, that premium increase alone will wipe out your entire operating margin.
So they are just being forced off the road.
Yes. It's disproportionately hitting the lowest price capacity in the market. The ones who use bad practices to artificially depress rates.
But here is where it gets really interesting to me. It's the drug testing debate. The hair follicle versus urinalysis situation.
Oh, this is a profound market distortion.
It's absurd. So Knight-Swift, because they actually care about their liability, they pay extra out of pocket to do hair follicle testing on their driver applicants.
Because hair testing gives you a historical timeline. It looks back months, whereas a federal urine test only looks back a few days.
Right. And the data they shared on the call is staggering. Knight-Swift's hair tests catch 14 times more drug users than the federally mandated urine tests.
14 times.
But the government doesn't allow these positive hair tests to be submitted to the National Clearinghouse, meaning Knight-Swift catches the safety risk, turns the driver away, and the government essentially ignores it.
Because the Department of Health and Human Services hasn't finalized the scientific guidelines for hair testing. So the Federal Clearinghouse only accepts the urine results.
So that driver just goes across the street, passes a basic urine test at a competitor, and gets behind the wheel of an 80,000-pound truck. I mean, explain the competitive disadvantage there. You are a rule follower in a loosely regulated market, and you're getting punished for it.
You are. Knight-Swift is shrinking their own labor pool to maintain safety while subsidizing competitors who hire those rejected drivers at lower wages.
It's just wild.
It is, but Knight-Swift is playing the long game. Those competitors eventually take the hit on crashes and skyrocketing insurance, and Knight-Swift is proactively cutting risk across the board. In their logistics segment, which is their brokerage arm, they cut the number of third-party carriers they work with by 30%.
Just since the beginning of the year, that is a massive cut.
Huge. They did it to combat cargo theft and fraud. Fraud rings have gotten highly sophisticated, double brokering loads and stealing high-value cargo.
So they just chopped off a third of their network.
Yep. They traded volume for security.
Okay, so let's look at the math again. You've got 30% of their broker network cut. You've got thousands of non-compliant drivers being forced off the road by the DOT. The supply of trucks is just plummeting. So what happens to the price of moving freight?
What's fascinating here is how violently the pricing power is shifting. We are in the middle of bid season right now.
And bid season is when shippers, like big retailers, negotiate their annual contracts with carriers.
Exactly. For the past couple of years, shippers have had all the power. They use digital brokers to find the absolute cheapest truck on the spot market.
But the call reveals a huge shift. Just a quarter ago, Knight-Swift was targeting low to mid-single-digit percentage increases for these bids.
Right, a slow recovery.
But today, they are pushing for high single to low double-digit percentage increases, moving from like a 3% ag at 12% demand in 90 days.
That shows an incredible amount of leverage, and it's manifesting in something called turnback bids.
Explain turnback bids, because this blew my mind when I read it.
So shippers award lanes to carriers at a certain contracted price. But the market capacity is constricting so fast that current spot rates are climbing higher than those newly negotiated contract rates.
So the paper they signed is already outdated.
Basically. So Knight-Swift is looking at freight they were awarded just months ago, and they are executing a turnback. They are rejecting the load at that proposed price.
Wait, can they just do that?
Yeah, in the truckload sector, an awarded bid isn't always a binding volume guarantee. It's an agreement on price if the carrier accepts the tender. By turning it back, they are telling the shipper, our trucks are not running at those old rates.
Wow. That takes a lot of confidence. You only do that if you know the shipper is trapped.
And they are. Shippers have been burned by bad service, cargo theft, and disappearing spot market discounts. So they are rushing back to quality asset capacity.
Meaning companies that actually own the physical trucks, not just brokers.
Right. Enterprise shippers are terrified of a capacity crunch. In fact, they were already initiating discussions about peak season demand support.
In Q1, peak season is Q4, the holiday rush. If they are trying to lock in November capacity in March, they are terrified.
They want asset-based relationships because they know the spot market is going to be a nightmare later in the year.
Which brings up this great quote from CEO Adam Miller. He said, in our industry, you either have drivers or you have loads. Rarely do you have them at the same time.
It's the fundamental pendulum swing of the freight cycle.
So how is Knight-Swift preparing to capitalize on this? Because right now, it sounds like they finally have the load side of the equation solved. The shippers are desperate.
They are using their massive infrastructure to make sure they have the drivers. They have proprietary driving academies, national terminal networks. They are pulling in the best capacity while the bottom tier gets regulated away.
And you can see they expect this to hit the bottom line fast. Their Q2 earnings per share guidance is projected at 45 to 49 cents.
Which is a huge sequential jump from the 9 cents in Q1. That proves they believe this double-digit pricing power is real and immediate.
Okay, so the truckload market is making all the dramatic headlines, but Knight-Swift operates other massive segments that are undergoing their own quiet revolutions. Let's look inside those segments.
Yeah, let's start with LTL, less than truckload. The mechanics here are totally different. You're consolidating smaller shipments into a single trailer.
Right, and the source notes a really notable improvement in their weight per shipment metric. It's moving upward for the first time in years.
And that's because they are deliberately transitioning from a regional network to a national network.
To bring on heavier, longer haul industrial customers.
Yeah, exactly. If you have a truck running between Ohio and Texas, your fixed cost fuel, driver wages, are static. So you want that trailer to be as heavy and dense as possible with high yield freight.
And it's working. March daily tonnage for LTL was up 6.9%.
Which is fantastic growth in a tough macro environment.
And we are seeing similar growth in their intermodal segment,
which is moving containers on rail and truck.
Right. Revenue grew 2.7% and load count was up 8.4% in March.
Again, showing the strength of being an asset-based conglomerate. They can cross-sell intermodal solutions to their massive truckload customer base.
But the part of the call that I found most instructive was the turnaround of U.S. Express.
Oh, this is a masterclass in corporate restructuring.
So Knight-Swift acquired U.S. Express a few years ago, and right now U.S. Express trails Knight-Swift's legacy brands by about 300 basis points in operating ratio.
Meaning they are significantly less profitable than the core fleet.
So what did Knight-Swift do to fix it? They shed thousands of tractors.
They had to. When they audited the U.S. Express network, they found that a staggering 40% of their loads were coming from unreliable broker freight.
40%?
Yeah, just highly volatile transactional spot freight. It's revenue that keeps the trucks moving, but it absolutely destroys your operating margins.
So they just fired the bad freight.
Addition by subtraction. They stopped taking the low margin broker loads.
But wait, so what does this all mean? If you drop 40% of your freight volume, you suddenly have thousands of empty trucks sitting in terminals. Why shrink a fleet right when a market boom is incoming? Wasn't that a mistake?
It seems counterintuitive, but the source text explains it perfectly. By firing the bad freight, they had a surplus of equipment. Empty equipment is a huge liability. You're paying lease costs, insurance, depreciation.
So they liquidated the excess equipment to stop the bleeding.
Exactly. And simultaneously, they instituted Knight-Swift's stricter driver standards at U.S. Express.
The hair follicle testing.
Yep. Yeah. So they shrank the driver pool, shrank the freight volume, and shrank the physical fleet.
But it worked. The structural repair was massive. They improved the U.S. Express CSA crash basic safety score by over 60%.
60% fewer safety liabilities fundamentally changes your insurance costs and casualty reserves.
So they scaled down to scale up profitably.
Exactly. Growth for growth's sake, like taking bad broker freight just to keep trucks moving, is toxic. Disciplined capacity management is how you survive and thrive in these market cycles.
Now that they've shed those expensive leases and lowered insurance claims, they're positioned to capture much higher margins now that rates are rising.
U.S. Express is lean, safe, and ready for the high-yield contract freight coming out of bid season.
Okay, so let's synthesize this whole journey, because we started with an earnings report that looked completely flat, almost depressing on paper.
9 cents EPS.
Right. But when we dug in, we discovered a freight market undergoing a massive regulatory-driven cleanup.
Knight-Swift is aiming to return to a normalized mid-80s operating ratio. And by weeding out the bad actors, dropping unsafe broker carriers, and leveraging their massive asset base, they are perfectly positioned.
Shippers are desperate for reliability, and Knight-Swift has built a fortress of it.
They really have.
But, this raises an important question.
I think I know where you're going with this.
Yeah, we spend so much time talking about the future of supply chains in terms of shiny new tech. We talk about AI routing, machine learning, autonomous trucks, drone deliveries.
Everyone wants to talk about the digital revolution in freight.
Right. But based on this deep dive, the most critical bottleneck in our physical economy right now isn't technological at all.
Not even close.
It is profoundly human. The algorithms are working fine, but the whole system is grinding its gears over basic human compliance. It comes down to hair follicle drug testing, English language proficiency, and whether a guy actually earned his commercial driver's license or just bought it from a shady school.
It's all human behavior.
So here is something for you to think about. As we rely more and more on these complex, invisible supply chains to deliver our daily goods, are we paying enough attention to the very basic human foundation that holds the entire system up? We want robots to deliver our packages, but right now, the economy is being held hostage by bureaucratic loopholes and chameleon carriers.
It's a fascinating reality check.
It really is. Thank you so much for joining us on this deep dive. We hope it changed how you look at the trucks you pass on the highway. We'll catch you on the next one.